Arthur is our next speaker. Good afternoon, Arthur. How are you doing?
Yeah, I'm doing really well. How are you, Susie?
Very good, very good. Thank you. Thanks for coming along.
Oh, my pleasure. Yeah, two speakers left, maybe the best two. Who knows?
Yeah, definitely pick your part up before you start. But I mean, genuinely, when Arthur did his talk at the last big commercial update, like literally, there was a lot of love in the chat about like, wow, why did I not know about this stuff? And again, it's a bit like what I said about VAT. If you once you know this stuff, Arthur's going to give you some mind-blowing stats on the amount of people that actually claim capital allowances, and he's going to tell you what they are and. Um, that probably 95% of people who own commercial property don't have. So it's super valuable. So I'm not going to talk anymore, Arthur. Over to you. So you've got till about five to five, and then we'll do 5 minutes of questions.
That's fine. Yeah, thank you very much. And thanks for having me. And following on from Tony and David, they obviously been explaining all about VAT. I'm going to explain about something called capital allowances. Now, capital allowances is a tax relief that has been around for quite a long time now, and it allows property investors to claim massive amounts of extra costs, tax deductible costs against profits. So this is a general overview. It's a very complex area. It's an area that's, as I say, it's been around capital allowances in one form or another for well, nearly 100, what's that, nearly 150 years now. So it's been around for a long time. There's lots of case law that determines what does qualify and what doesn't qualify. But this is what the revenue say. On their website, it says you're entitled to claim capital allowances when you buy assets that you keep in your business. And they talk about a number of different things. One of the things they talk about is plant and machinery. Now, most people think plant and machinery is diggers and tractors and silos and that sort of thing, and it is. But in a property sense, it covers a whole host of other things. It covers things like your second fix items, so all your heating systems, your lighting systems, security, all of those sorts of things that make the building work. That has nothing to do with the structure. You're able to claim a tax deduction in your accounts. And the way that it works, and I'll go through it more in detail shortly, is we value those assets for you when you buy a property or when you develop a property. You claim those amounts in your tax return, your company tax return or your personal one, and then it reduces the amount of taxable profits that you make and saves money off their tax bill. And who doesn't like money off your tax bill? So there's really two opportunities to claim capital allowances. One is when you buy a property. So when you buy a property, you buy the land that it comes on, you buy the structure, and you also buy all those little things, all those second fix items that make the building work. And so it's really a breakdown of your purchase price into its component parts that allows you to then claim the capital allowances part of it against your taxable profits. So what we do is we go to every single site and we look at each property and we identify well, the type of heating, the type of lighting, the security that's on there. And it goes down to some really quite minute levels of detail, sort of door furniture we can look at, and a whole host of other things that are in a particular property. But that's when you buy a property. The next opportunity is when you develop a property, if you develop a property. And again, you're spending more money on a property. There's another opportunity to claim capital allowances as well. You're putting more plant and machinery in, if you're extending it or putting something in that wasn't there before. Typical examples are installing emergency lighting or air conditioning or fire detection systems that weren't there before in a building. You're able to treat those as capital costs and claim those as a tax deduction against your accounts, against your profits. It does help some people to think about capital allowances as the tax depreciation of your assets. I'm sure you'll all be aware that if you have a profit and loss account for your business, you'll have all of your income, some of your expenditure, and there'll be a line on there for depreciation of your assets. Now, depreciation obviously goes to your management accounts and it shows you how profitable your business is doing. But when your accountant actually does the tax computations, he cannot use depreciation as a deductible expense. So he has to ignore that, and instead you're able to claim capital allowances. You don't get them automatically though. It's not like just saying, oh, 10% of the property value You actually have to have them identified separately and valued in some sort of report that goes off with your tax return to HMRC. So it just helps some people think about it in that particular sense. And whoever owns the building is the one that's entitled to claim. So whether you own it personally or with a business partner, you can claim capital allowances personally or your share of them. If it's in an LLP, each member is entitled to claim capital allowances on their share or their membership part of the agreement. If it's in a limited company, that's perfectly fine. Whether it's an SPV or an ongoing limited company, it's the company that claims the capital allowances and claims that deduction against their corporation tax. If it's legislated for, it's not the most riveting read, I'll grant you, the Capital Allowances Act 2001, but it does set out all the rules about what you can do and how you can claim these allowances, what properties qualify, what properties don't, and the various circumstances around that. It doesn't matter how the property is financed or even the planning status of the property. It's how the property is traded, which is important. So the scope of capital allowances, it covers a number of different things. More in the past, but they've got rid of some of the more complicated things. Generally, we talk about plant and machinery allowances. That's all the second fix items, those small bits that make the building work, that's nothing to do with the structure. Although the stuff that is to do with the structure, since 2018, you can actually claim something called structure and buildings allowance. And structure and buildings allowance says exactly that. You can claim the whole value of the structure of the property, as well as the plant and machinery parts within the building as well. So the only thing you can't get tax relief on is the value of land when you buy it. So imagine the sort of percentage of that, 55, 60, 70% of your investment you can get tax relief on. But talking about land very briefly, there is actually some other tax relief available called land remediation relief. It's the single biggest tax relief the government offer. And if some of you may have come across buildings that might have a Japanese knotweed in the ground or may have asbestos on site, and that's a contaminant. So any money you spend cleaning up that contaminant, you're able to claim 150% of those costs against profits, which is a brilliant tax relief and is there to encourage people to have a clean environment and to benefit from the tax relief on that as well. So this is kind of the scope of capital allowances. To put this into sort of real numbers, this is how it looks from a commercial point of view. So we'll look at three circumstances: one, buying a commercial property; two, then developing a commercial property; and then looking at some land remediation relief. So if we first of all say, right, okay, the commercial purchase of a property, what you buy, let's say for every £100,000, there's going to be plant and machinery. So second fix items, generally 20% or so. So £20,000 of that £100,000, you can claim capital allowances. And you get all of those in the first year when you buy your commercial property. If it's in a company, you get an unlimited amount for that first year. If you have it in your own name, you're only limited to £1 million worth of capital allowances. Well, that's going to be a good problem to have. So you can claim for all of that plant and machinery in the first year. You can also then claim the value of the structure. So say it's £45,000, the value of the structure, but you get that over 30 years. And it's a bit like the very old industrial buildings allowance that some people may remember, but you get that over the next 30 years. And if you sell the property, what's remaining goes with the property for the new owner as well. So that's 65% there of your purchase price that you are claiming as a tax deduction over a number of years. If you own it personally and you pay 40% tax, well, that's going to reduce your net investment by 26% in that property. And that's a massive input. When you look at the returns that you can get, the yields you might get on the property, you can factor this in, and all of a sudden certain deals might become a lot more lucrative in that respect. If it's in the company, that's going to reduce your net investment by 16% in there as well. So these are the tax savings we've got there. But it gets even better when you look at developing a property, because when you develop a property, you will either be spending it on plant and machinery or you will be spending it on the structure. So 100% of your development expenditure can be written off against profits by using capital allowances. So it will either be plant and machinery, and in this example, I've said, well, let's say it's £50,000 plant and machinery, £50,000 structure. So it's £100,000, 100% of what you spend, you can get that back as a tax deduction. And if you're a high rate taxpayer, that reduces your net investment by 40%. So imagine saying, well, okay, I've got £100,000 to develop my property, but in real terms, it's only going to cost me 60 because I'm getting all the money back through tax. So it's another way to think about it. It's a really useful thing to know about capital allowances, and just to appreciate that whenever you spend money on a premises, there's another alternative, or there's another opportunity to claim tax relief. So for land remediation relief, say you had some asbestos in the property and you cleaned it up, had to have a new roof put on, there's a remediation cost. As long as you didn't cause the contamination in the first place, then you're able to claim the cost of tidying it up. And if you had to spend £50,000 cleaning this up, you could claim that £75,000 against your taxable profits. Now, it is only available to limited companies, but therefore, of your £50,000 investment, you're going to get 19,000 of that back in corporation tax. So again, that reduces quite significantly your net investment in that particular property. So knowing that there's these tax reliefs available out there, you should be aware of that so you can apply that to your various circumstances. So some basics on capital allowances. If you own a property personally, there's a really useful thing you can do, especially if you're at the start of your investment journey. There's something called sideways loss relief. And what this allows you to do is, if you are in a job and you're paying tax through PAYE and you're just starting your property journey and your properties attract capital allowances, then what you can do is you can use those allowances from your properties and you can use them to get back the tax that you pay through your job. And that's called sideways loss relief. So if you imagine your income streams, you have different pools of income, and what you're allowed to do is you're allowed to use the loss from certain things, capital allowances being one of those, the loss relating to capital allowances from your property to offset the tax that you've been paying on your income through your PAYE. So lots of people then, when they do their tax returns, get great big checks back from HMRC. And the way that it's done is it's calculated on your sort of net position, if you like. So you've earned £100,000, but you've also made a tax loss of £50,000 in your property business, and you effectively net those off and say, well, I should only have been taxed on 50 rather than taxed on the 100. So you get some tax back in that respect. So sideways loss relief, very good. I would urge people in that position to Google that, research that, and have that in the back of their mind if you're planning to invest in these types of properties and paying tax as well. If you have a company set up, there's something similar called group tax relief. And this is something that a lot of companies operate. When I was the UK accounting manager at IKEA, this is exactly the thing that we do, and lots of companies do this as well. You tend to have a retailer that makes all the profit but doesn't have many assets, so should pay lots of tax on the profit. You have a property company as well that will own the stores, for example, doesn't make any money but has all the assets, and you might have a couple of other importers or other companies. But you can put them together in a tax group and you can say, right, the losses from capital allowances in this company can be offset against the profits in this company, and you're only taxed on the net position. And a lot of property investors do this, who perhaps might operate some flipping as well, some development works. They will have a development company which might make lots of profits because they're making money flipping properties, but they might also have a holding property for properties that are their long-term investments. You can have those on a group tax scheme, very straightforward to do. You just have to get it declared, and that means that the capital allowances from the holding company, if they've got these properties, can then offset the profits that you make through flipping and developing properties that way. So something just to be mindful of and useful if you're in that position or thinking about doing that. It's legislated for, introduced in 1878. It's not some sort of fancy loophole. It is proper legislation, and all you're doing is taking advantage of it. A lot of people think that their accountants get involved with capital allowances. They do to a lesser extent if they come across very obvious invoices for a capital allowance type item. So if you're putting in a new air conditioning system, should see that and pick that up. But they don't get involved in generally the purchase valuations. They don't go to site and identify everything that you can claim there as well. I know there's some questions coming through, so I've only got a few more slides, and then I think if we tackle these, Susie, we should be good. So in terms of the properties, yes, commercial property qualifies for capital allowances. Some other residential type properties do as well. The actual legislation says you can't claim on a dwelling house. If it's somebody's main residence, you can't claim any capital allowances. There's special rules for HMO properties, serviced accommodation, holiday lets is a bit tricky because the rules stopped on the 5th of April. But yeah, generally those types of properties there are some opportunities, shall we say. And about 3 or 4 years ago, well, probably about 6 or 7 years ago now, HMRC did some investigations, and they said 96% of property transactions hadn't maximised their capital allowances. That's 96% of all property transactions hadn't maximised their capital allowances. And there's a real lack of knowledge in the market regarding this. I've been doing this for 18, 19 years now, and I still come across a lot of people who don't know about it. Certainly the sellers that we come across have no clue about capital allowances. And it's a real not minefield. It's a real sort of area where it's not really utilised for that. So it doesn't affect your capital gains tax. Claiming capital allowances doesn't reduce your balance sheet value of your properties, as some people might think. It's an offline tax adjustment. So what's in your accounts will stay exactly what's in your accounts. It's utilised on your tax return, which is the important bit for paying your money. So whether you claim capital allowances or not, you will still pay the exact same capital gains tax when you come to sell the property. So there's a couple of recent changes to capital allowances, which I think everybody should really take away from today. The biggest one is that you have to agree with the seller the value of the capital allowances if they could have claimed them. So if the seller could have claimed capital allowances, it's a business or a person, and they had a commercial property, then you have to have some sort of agreement with them for the value of the capital allowances so that you can claim that particular tax relief. But this is quite tricky because capital allowances can only be claimed once in a property's lifetime. And how do we know that the seller hasn't claimed it? Well, it's quite straightforward. If they have claimed it, it'll be splashed all over the sales contract or the CPSE inquiries. You'll get lots of terminology saying, we're selling you the assets for £1. The sale price of the property won't change, but the value of the assets within it will only be £1. It'll be very, very obvious. Most people haven't got a clue about capital allowances. So the sales contract normally never says anything about capital allowances. But this is also a real problem because you don't necessarily want to alert the seller that this massive tax relief is available. So you need to be a bit canny here and just say, okay, how can we get them to agree to this without actually telling them about it, for want of a better phrase? The main process that we go through is by putting a small clause in the sales contract, just a small clause that says the seller hasn't claimed capital allowances and they will agree to the value that the vendor will identify within 2 years of purchase. It's a bit more basic than that, but it effectively forces the seller to agree to a value of capital allowances that they don't know yet, and it's probably best that they don't know because they would be interested in them claiming the value of the capital allowances rather than passing them on. So that we generally get that agreement in the sales contract, and we've got 2 years, according to the updated Finance Act 2014, we've got then 2 years to do the valuation, and then because they've signed the contract, they're legally obliged to agree to the valuation that we provide them. That's the easiest way to do it. Very occasionally, they're happy to sign a retrospective agreement if they don't want anything in the contract. That sometimes happens. And also, if the vendor completely won't agree and there's a decent amount of value of capital allowances, we can take them to a tax tribunal. Well, that sounds pretty scary. In reality, for capital allowances, it's just an admin process, a laborious admin process, but still one that we have to go through to do that. And as I mentioned, with the sort of the government wanting to encourage people to invest, I mean, God knows what they're going to say next week. But at the moment, you've got full expensing to the end of the Parliament. They'd said if it's a limited company, so all the capital allowances that you identify when you buy a property, you can claim those all at once. Or previous to that, it was £1 million. Or if you're an individual, you can claim up to £1 million in the first year of ownership. So that covers most people on that. And really, from this, what I wanted to do with this one, I've got a couple of examples just to run through with you very briefly. But this is the sort of capital allowances claim process. It's very straightforward. But the biggest point, and I'll say from everyone today, just to take away that we've got to deal with the compliance. We've got to deal with getting the seller to agree to the capital allowances value at least within 2 years of that completion date. Ideally by getting them to sign a contract or getting them to agree to it retrospectively. And the reason for this is that the government introduced a mechanism whereby the value of the capital allowances had to be identified and logged with HMRC. And if that wasn't done within 2 years of a completion date, nobody in the future could claim capital allowances on that property. Because prior to 2014, the value of capital allowances that anybody could claim in a given year was almost unlimited, unquantifiable to the revenue. And so they put this process in place to say, if a property changes hands, you've got to quantify the capital allowances within 2 years, otherwise the opportunity is lost to the future. So this then begs the question to a lot of people, hold on, I bought my commercial property 3 years ago and I haven't agreed anything with the seller regarding capital allowances. Well, potentially you've missed out then, because that opportunity has then passed. However, I will just briefly say, it depends on who the seller is. The agreement says if the seller could have claimed allowances. So imagine a scenario where the seller couldn't have claimed allowances because maybe they're a pension fund, or maybe it's the local authority that you bought a property from, or maybe you bought it from a charity. All of those people don't pay tax, so they couldn't claim any capital allowances, so automatically you get the rights to claim those, and there's no time limit on that either. So there's just something to be aware of. You've got to deal with the capital allowances when you transact a property. The valuation is then done by site survey, and then the report is submitted with your tax return, and then you get a refund of tax or mitigate future income tax, which is also very useful. So a couple of minutes just to go over this. This is one example on the south coast. It was a mixed-use property. I had some storage upstairs actually, converted into residential flats, some holiday flats, and some serviced accommodation and some commercial on the ground floor. The whole project, £675,000. The plant and machinery value was £190,000, and it was owned by a limited company, and they saved £37,000 in corporation tax. Or look at it another way. This was an SPV. This meant that they could make £190,000 in profits before they start to pay any tax. So that's another way to look at it. This is an office block in just outside of London. Bought a small amount of development works for £3 million. We identified nearly £700,000 worth of capital allowances that were in the property that were available. And the individual that owned that, they saved over £120,000 on their tax bill, which they could then use that money to reinvest into their future business, into their sort of future investments, into another property. It's another way to recycle your cash, which is also good. So I think I'm pretty much bang on time there. How about that? That's not
Super
bad.
impressive. Thanks,
Even if I
Arthur.
do say so myself. Very high level. That's a lot of information. I appreciate that, Susie. And it is very detailed. I've really just scratched the surface of that. But I'm happy to go through the questions if we have some.
Yeah, let's do that. We do have a lot of questions actually. We always do field sessions. That's brilliant. And I think it's definitely the kind of thing where you need to know that it's available. You need to kind of understand the principles, and then someone like Arthur can obviously take you through it. So, what kind of property can you claim allowances on? Commercial, resi,
Yeah, so the legislation, sorry.
accommodation? Sorry, there was a list, but yeah.
That's sorry. Yeah, so as long as it's not somebody's principal residence, then you're able to make a claim. So it's typically commercial property, HMOs. There's been a specific bit of case law a couple of years ago to determine what you can claim in there. Serviced accommodation is very popular at the moment. So but yeah, commercial, retail, dental surgeries, blocks of flats you can claim for the communal areas, a whole host of things. That's generally what you can claim.
Yeah, perfect. And can you claim in a SAS?
No, because SASs are outside of the scope to tax. So it is quite interesting, though. They do buy commercial properties, obviously, by their nature, but there is an opportunity to preserve the capital allowances. So you can't benefit yourself within the SAS, but then you can pass that benefit on to the new owner should you sell the property. And of course, the property is going to be worth more if you sell it and the tax relief is available. So even though you can't benefit directly yourself, still agreeing that value with the seller when you buy it, you can then pass that on to a new owner at a higher value, effectively.
Yeah, the other thing you can do is you can buy in a limited company and obviously sell part back out to the SAS. If there's enough of a capital allowance claim to make that justifiable, and obviously you need to weigh that up. That can be a way to do it as well, can't it, Arthur?
Yeah, I think one of the most tax efficient scenarios that I have come across was a client of mine, really clever chap. He bought a mixed use property. It had hairdressers on the ground floor. It had a regular residential flat on the top floor. Bought it, claimed the capital allowances after converting upstairs into short-term let. Claimed the capital allowances, and in a couple of years' time, split the title on the property, and then transferred the commercial part into his SAS as well. So any future rental income from that is obviously tax-free as well, and he's benefited from the capital allowances, and it's all legitimate. You're all able to do that utilising the legislation.
Yeah, perfect. Okay. If capital allowance has already been claimed, then a new buyer buys, adds new capex. The question is, can you claim then capital allowances on the new capex? Obviously not the old, but the new.
Yeah, any new expenditure on the property, any more capital introduced is new expenditure. Nobody else is entitled to claim it apart from you. So yes, that's perfectly fine.
Is it possible to check before you buy whether there's capital allowances?
Well, there is, as it happens, a massive, great big database of all the capital allowances that have ever been claimed on any property, or at least back to 1996. Unfortunately, it's owned by HMRC and they don't give it to anybody. I know because I've been trying for 20 years to get it. But the onus of checking is on the taxpayer. So part of the due diligence that you can do is look at who you're buying from. If you're talking to people individually, you can make subtle sort of noises to sort of say, does the property come with any asset write-down values, or does it come with any additional tax relief you might be aware of? Have you had an asset survey done? Is there any other, any other reliefs available that might be on there? Some people are really open about it. If you look at, or if you're able to find out if they've been making profits for the last few years, if they haven't, then there's no point in them claiming capital allowances tax relief because they're not paying any tax, because they're not paying any profits. So having an understanding of who you're buying from, if you're buying from a limited company, you can have a look at the company's house to see how their assets are being held. Sometimes they keep them as stock properties, and that's good because you can only claim capital allowances on fixed asset properties rather than stock properties. But the biggest sort of identifier, without directly saying to them, have you claimed any capital allowances? Although some people will be happy to volunteer that information. The biggest identifier is the CPSE inquiries and the sales contract as well. And if, as I said right at the beginning, if they have claimed anything, then it'll be splashed all over that sales contract. But that's not necessarily the end of the world, because if they have claimed something, there's always a counter argument to say, well, I'm buying this property. I thought I was getting the tax relief, but now my net investment has gone up. Let's renegotiate the sales price because of that. Might happen. It's something else to be aware of.
Yeah, when I was in the corporate world, we always used to say we put it in the heads of terms about capital allowances, but that's because everybody knew about them. They're all sophisticated investors in corporates, whereas if you're buying from SMEs, obviously, not many people know. So, and Louise makes asked a really good question. What does a successful capital allowances claim actually mean? So, is it a cash refund, or is it offset against tax, or what is it?
Yeah, it depends either or both. So if you've paid tax in the past and you've got a property, what you can do is you can make a retrospective claim on your tax return to include the capital allowances, and then you can get a rebate from HMRC. Or if it's a new purchase and a new company, you wouldn't have paid any tax yet because you haven't made any profits. You can then use capital allowances to basically extend the period of time when you would need to pay any income tax, corporation tax on that. So it depends on who's buying it, if you've paid tax, if you've already owned the property on that as well.
Okay. Looking at a laundromat or dry cleaner, they've claimed annual capital allowances, small amounts annually. What is this and how do they know? How do I know what it was? Was it plant and machinery or against the property?
Yeah, so I mean, generally, if you're, well, there's two things. If you are continually updating and maintaining buildings and things, there'll be lots of costs that they'll be writing off against profits. That won't necessarily be capital allowances. So I assume that you've seen their tax computations, in which case they may be just buying small improvements to the property, extract a fan here, or maybe a new heater over there, or whatever it might be. And those very obvious items, yes, I would fully expect the accountant to go, I know it's a heater, I know it's plant and machinery, I know I can claim capital allowances, and that's what they'll be doing. What they won't be doing if it's a large investment, if it's extensions and that sort of thing, they won't be breaking down the large development works into their component parts. So I'd imagine it's small bits of investments, because it applies to cars and computers and other things as well. So I'm just talking about buildings in this respect. So it might be that there are more computer items or new laptop or whatever it might be. So yes, that's what those items could be. But if you've got the
Yeah.
books, then ask the accountant what he's claimed capital allowances on already.
Yeah, perfect. And if you're buying for receivers and they're not interested in helping you, which they're generally not, uh,
Yeah,
you do.
it's quite tricky, and the same with if you're buying at auction as well. Because a lot of the time a company or an individual has got into liquidation and they're not available to answer questions or comment or make any agreements anyway. And certainly the receivers of the auction houses don't really care. I've tried to work with a few insolvency practitioners, but it's just not on their radar really. So yeah, the best thing to do is we can find out as much information as we can. Generally, we won't is bankrupt or the company's dissolved. So here's what we think. And we can send over a valuation to the tribunal. They will contact all the various parties and they will come back with a decision on that.
Yeah. Okay. Good stuff. And then last one, a colleague has bought a pub he's converting to resi and has been told he can't claim capital allowances. Could he have done on sale as it's still commercial until he's finished the work, or could he operate it as something commercial for a short while before changing it to resi?
Yes. So the property has to be non-residential. Okay. So if you're buying a commercial and converting it into residential, there's limited opportunities there. The best thing to do is buy a commercial property, operate it as a commercial property, rental income coming in, claim all of your capital allowances. If you've then had a business change of mind to go, oh, I quite fancy this as a residential property, convert it into residential, then trade it as serviced accommodation, because then you can claim a large amount of capital allowances on the development works, and then after a couple of years, 18 months or so, change them to buy to let units and don't deal with the hassle of short-term lets. That's the kind of the most tax efficient way or capital allowances efficient way to do that. But that obviously is over a number of time. But the key thing is it has to be a fixed asset in your accounts and it has to be trading as a qualifying activity as well.
Yeah, perfect. Arthur, thank you so much.
I'm
Always,
sorry I've run on a bit there, but thanks very much for having me anyway.
no, super, super valuable questions. So yeah, thank you so much for that. And as always, a great presentation. So yeah, thank you. And your details are in the chat. So people, please do get in touch with Arthur.
Bless, thank you.
Thanks, Arthur. Mark.